Understanding the yield curve's uninversion, implications for investors. The top 1% have mastered the art of wealth management, often utilizing strategies far beyond the conventional wisdom offered by typical brokers or financial advisors. Because financial independence is a necessity, at All Things Money we teach others about these lesser-known financial strategies. If you're skeptical, try asking your financial advisor to explain the yield curve or its inversion and what it signifies. The yield curve's current state. For over 2 years, our yield curve has been inverted. What does this mean? Bonds operate on an inverse correlation between their price and the interest rate they offer. For instance, if you borrow $100 at a 1% interest rate, you owe $101. However, if circumstances force you to sell this debt for less, say $99, the new holder still receives $101, translating to a higher effective interest rate for them. Consequently, as bond prices drop, their yields rise. The Federal Reserve's adjustments to interest rates also impact bond yields, aligning them across different maturities. Indicators of a recession. A standard yield curve typically shows lower yields for short-term debt and higher yields for long-term debt. An inverted yield curve, however, reverses this trend, indicating higher yields for short-term debt and lower yields for long-term debt. Currently, our yield curve is inverted, with the 6-month U.S. Treasury yielding over 5%, while the 30-year U.S. Treasury offers around 4.28%. Historically, an inverted yield curve has been a precursor to a recession, which typically follows after the yield curve reverts to normal. This pattern can be observed in past economic cycles, including those in 1980, 1990, 2001, 2008, and 2020. Types of yield curve uninversions. There are 2 primary ways a yield curve can uninvert. 1. Bear steepener. The long end of the curve rises, causing long-term bond yields to increase as their prices drop. 2. Bull steepener. The short end of the curve falls, leading to lower yields for short-term bonds as their prices increase. We are likely to experience a combination of both steepeners in the current economic environment. The role of the Federal Reserve. The Federal Reserve is poised to cut interest rates, a move that will primarily trigger a bull steepener by lowering short-term borrowing costs. This will benefit the U.S. government through cheaper deficit spending. Simultaneously, long-term bonds are expected to sell off, causing a bear steepener as investors seek positive real returns amidst rising inflation and higher borrowing costs for the private sector. Employment and economic indicators. Rising employment costs and weakening economic indicators suggest a challenging environment ahead. Full-time employment is decreasing, jobless claims are rising, and retail sales have stagnated. These factors contribute to the likelihood of a significant market correction. Yield curves and stock market performance. Historically, yield curve uninversions have correlated with significant stock market downturns. Past instances include market corrections ranging from 20% to 57% following yield curve uninversions in 1980, 1990, 2000, 2008, and 2020. Preparing for market volatility. Rather than fearing potential market crashes, investors should see them as opportunities. Intelligent hedging and strategic positioning can enable you to profit during downturns and capitalize on undervalued assets post-crash. This approach allows you to build wealth by buying assets at reduced prices. Conclusion. Understanding yield curve dynamics and their economic implications can provide valuable insights for investors. By preparing for potential market volatility, you can protect and grow your wealth effectively. Thank you for watching, and have a great day.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.